Okay, guys, so I'm going to start the session today by asking, is there any questions that anyone would like to come forward and ask, or if they had any questions regarding any recent lesson that we had? No one with no questions? Everyone was asking me questions and now there's no questions. Okay, well, if that's the case, no problem. We are going to continue. Okay, so basically we spoke on Friday and
Sorry, Darren. Sorry,
yes.
I was on mute. I was trying to speak. My only thing is that with mitigation and breaker blocks, I understand when you explain it, but then going to identify them myself on the chart is quite difficult. So that would be my only, not so much question, but like feedback. So maybe if you could just like go over it really quickly, like summarize them again.
Okay, so breakers and mitigations. Is that
Yes,
what you
please.
said? Okay, no problem.
Thank you.
Okay, so let's just quickly remind ourselves exactly what we are going to talk about then. So when we look at a breaker or mitigation, it is really based off of structure. So we said that with a mitigation, we want to see price come higher or, go lower. Doesn't really matter whether it's a buy or a sell, it's the same sort of thing, just in reverse, a mirror image. So here price decides to not then go higher and retraces. Again, tries to go higher again, but if there would be a liquidity below, or sorry, above that, then in opposite, both bullish and bearish, we'd get something like this. So both the high and the low have liquidity sitting there, and the fact that the market did not take the liquidity and reversed this area over here is what some people on the charts, as you've seen, they call it a shift in market structure. I know it as a market structure shift. That's how I learned it. But really, in a nutshell, it's potato, if you will. And obviously, if this version in reverse over here, because price trades through it like that, then this area over here is going to be what we call the mitigation over here. This is the mitigation zone. Call it a zone because it could be quite large depending on 4 hour, daily, weekly, whatever time frame you are going to use. But in terms of if we were looking at it from a line chart perspective, that is what the mitigation block would look like. And this is based off of structure and based off of the fact that there is a failure swing to the downside. If we look over here at this low, failed to take out the previous low, and this high failed to take out the previous high. So there is a failure swing over here. So that is what to call a mitigation block, is a failure swing. It fails to take out the liquidity and then trades through, creating that market structure shift. So really depends on what time frame you look at these mitigations, but obviously the higher the time frame you look at, the more solidified the evidence will be. 5 minute mitigations might not last very long. 5 hour mitigations might last very long. So it really depends on what time frame that you're going to use. So if we look at, for example, a clean chart here of whatever, 1 hour, for example, and let's just keep it simple over here. So this one is different because there's actually a breaker here. So this one here, there's a breaker. This swing high, if we zoom in there, this swing high takes out the liquidity of this low, price reverses and trades higher, coming back to test the breaker. Now it's not depending on that whole word of resistance becomes support and support becomes resistance, and then we take the trade based on that. It's based off of liquidity, for particular this breaker over here. And as we can see over here, there'd be failure swings on the downtrend, and eventually price will come into a discount, create a turtle soup, which is this liquidity over here that was raided over there. And when that liquidity was raided, basically price reversed above this swing high, which creates this as a breaker and not a mitigation. There is a mitigation over here where we see this swing high failing to take out this swing low. So there is a swing low here. So that swing low was created from this swing high. Although this is the breaker, there is this swing low, and price made that swing high, traded lower, and failed to take out this low. So over here is mitigation. So this over here is mitigation, like that. So that if price was to trade through it, this is that sort of market structure shift in terms of recognizing a mitigation block. Now you can see that as we get away over here from the old low and possibly some kind of rejection block and maybe an order block forms, there's a void created, and after the old low, after the rejection block, after the order block, after the void comes then possibly your breaker, possibly your mitigation. So you can see now as we get away from the old low in terms of where the other old high is, this trading range over here, if we divide it up, this makes up our PDA, and we know that anything below here would be discount. So you can see that the mitigation for this area and the breaker are forming very close to the equilibrium of this trading range. So when I said past lesson, I think, or maybe the prior lesson to that, that mitigations occur near equilibrium, you can see how that is occurring, and it's not the deepest level of discount or the lowest low that we are buying at. However, there's a lot of sort of supporting evidence behind buying, the fact that there was a liquidity raid over here, then possibly an order block, a breaker, and then failure swing low to break higher. So, there'd be a reason for price to trade higher once it had traded lower to take out all the buy stops, previous price action over here, because you can see there now it's trading that liquidity over there. But in terms of this price action that we are looking at right now, we see a break over here and we see a mitigation over here. And that's generally, you don't find every single price swing that's got a swing high and a low. Not every single PDA element is going to be in that price leg. Like there may not be a void in here. There may not be a mitigation in here. There may not be a breaker in here. Don't force it onto the chart if it's not there. And for example, I think it was the Bakaran where he said that why did a particular mitigation not, hold? And the answer to that is, well, let's look at his chart he sent me. So he sent me a chart and asked why this particular mitigation did not hold, which was this one over here. So this one over here. So I would imagine that this is his mitigation that he had identified, and then we can see that price traded through that. So that's what he had identified as that mitigation. We can see there price makes a low here, comes back up to mitigate, and then it sells. So in my eyes, I see that mitigation as holding over there. And once it's been traded to, I would not use that same mitigation block again, because now you can see here, it took those equal lows there, and it looks like he's marked up some kind of void or order block here. So it took out the lows and, raided it and closed this inefficiency here. And then now the fact that it's from this price swing to that price swing, we're in a discount of that range. We did a turtle soup over here below these lows. Is already mitigated, so we should not use that same mitigation again. So once you've identified an order block, once you've identified a void, once you've identified a breaker, if price trades into that allocated zone and trades away from it, be it buy or sell, we should not use that same breaker. We should not use that same void. We should not use that same order block, because that PDA has been used. When I say PDA, it is all the elements of what we are learning. Order blocks, forwards, old high, rejection block, etc., etc. Those are PDA elements, and in this case, he marked up a mitigation, it traded into it, so it mitigated it, and then he marked up and thought the price was going to mitigate off of it again. So no, you should not use that. I don't know if Zakaran is here currently, but I'm sure he'll make sense of what I'm explaining here. And if anyone had a similar question, as to why a particular mitigation or breaker was, not holding, well, did it previously hold or was it traded to already? And if that's the case, then sort of looking higher or looking lower for the next level of premium and discount. So this is something I have to show us, which is what is our PDA over here. So let me just look for it. I did have it here now. This is our PDA array, which stands for premium and discount array, and I don't see it now for some reason. It's simple though, I will just find it here. So this is our PDA array, okay? And if we look at what this essentially means here, is that when price decides to make a high, trades higher over here, okay, essentially it's going to make an old high possibly and then trade away. And when it's made that old high, and whatever the trend of that would be, we would be looking from that old high into a discount of that old high for what it could possibly trade into over here. So we would say if the daily is bullish and the 4 hour starts to go down now, what on the discount on the opposite end, because in the middle over here would be our equilibrium in the middle. So what below this equilibrium point do we find for a discount? And that's essentially what the purpose of this PDA is. And obviously the lower down in the PDA you go, the deeper in discount you are, and the higher up in premium you go, well, the more oversold something would essentially be. Okay, so you can imagine what lies above old highs or what lies below old lows, which is liquidity, and that's where your turtle soups would essentially form. So looking at what I just explained now about over here, where this is the old low, and if we look at candlesticks over here, it's possible we might find some kind of order block in this region, and then we said that over here is that breaker here. So by the time we've made this old high up here, traded lower, and made this low, we can see this PDA is starting to form over here. So turtle soup below the old low, came back in and retested the mitigation. So let's just do that in reverse. So came down, turtle soup this old low and traded higher over here. So when we were buying down here, it's a very deep discount, right? But when we were buying up over here and we had previously raided this swing high over here like this, because that would have been that swing high where price would have traded, so above here would sit liquidity, and when price traded this swing high, that was the breaker. So in terms of when price breaches that level over there, look where we are in terms of this discount array over here. We are sort of looking at this zone over here, which is mitigation and breaker up top here. So in terms of where the low was just created to where the breaker and mitigation is occurring, this is a deeper discount, and then as we move up, we're getting closer to the equilibrium, and it's still technically discount, but not as deep of a discount as the old low or the rejection block or the order block, for example. So example, if you were a person who likes to trade order blocks and you're buying, bullish order block, bearish order block, that's not actually the highest or lowest level of premium and discount. Obviously, there's the rejection block, the old low, and then underneath or above would sit liquidity. So there's this whole three items over here lower than the order block, essentially. So you're not really buying at the deepest or highest level of discount or premium. When you're buying an order block, for example, it's sort of the middle of the middle. So if this is equilibrium and you divided the equilibrium down to the old swing low, you're sort of buying at the equilibrium of that range. So that's essentially what a mitigation would look like. And you can pretty much do it on any time frame, whether it be a daily as well. And I'm just doing it on a line chart, but it's really the same thing. If you understand what a line chart looks like, then you can understand what a candlestick chart looks like. If you understand a candlestick chart, and you understand a line chart, because all the candlesticks are is the opening and closing prices, and the line chart is where price closes only, right? So pretty simple. Over here we have this low, which is a daily chart. So this low right now has raided liquidity. As we can see, if we zoom out here, all of this liquidity over here has been taken. Where's the liquidity? The liquidity is over here, the liquidity is over here, the liquidity is over here, and that is the last swing low before the liquidity grab. So this, once this closes over here, this we can say is the breaker over here. So once that breaker has formed, well, now there's a live price action example of a potential breaker, and if price closes below here, then this is our breaker. Because why is it a breaker instead of a mitigation? Because of the liquidity grab. So if price was bullish and it was going to continue higher, then it should not break that swing low over there. So that is why we refer to this as the breaker over here. In terms of breaker versus mitigation, well, failure to have taken out the highs would have resulted in a mitigation. So something over here like this would have been a mitigation, short-term mitigation over there. You can see that this high here failed to take out this high here, and then the market structure basically just traded lower. However, the overall time frame was bullish, so this is basically just a short term. So if we pull that on the 4-hour, for example, over here, where it sort of mitigated, you could see it sells off a bit only to grab the old lows down here. So there's that sort of failure swing that we identified to failing to take out that high, and then that would be our mitigation in this zone over here, and you can see it trades lower. Now in terms of, like I said, premium and discount, the swing high, the swing low, buying mitigations or selling mitigations is near some sort of equilibrium, and it's not the highest or lowest level of discount. So those moves must be anticipated, that if you're buying a breaker or selling a breaker, or buying a mitigation or selling a mitigation, that depending on what time frame it is, the move may have already unfolded and you're not in the highest level of premium or discount, and therefore your profit taking should only be in accordance with where you see market price going to. So if this is like the breaker, for example, we could say that over here we see that price is likely to head for this equal lows over here on this what's this, USD CAD. So that is the likely point for price to trade into. It's pretty much a very likely scenario that price would trade into there. And depending on, like we said, if that is in fact the breaker over here, it would really depend on what happens with this liquidity over here. Because like we said about internal, external, this would be 4-hour swing high, which is up top here, which is external up top here. So that would be external range liquidity over the top, and this would be external range liquidity at the bottom for the 4-hour. But for the daily, we can see that the external range liquidity on the daily would be somewhere down here and up top here. So same swing high for external range liquidity on the daily, different swing low on the daily for external range liquidity. And if in terms of, obviously, if you go to the weekly time frame, well, then you're going to get different results, because all the way down here would likely be external range liquidity. However, there's, before price would run the external range liquidity, it would have to grab this liquidity over here of the daily external range. It would have to come into this daily void and order block over here. So in terms of price just blasting through here, it's going to run into a little bit of difficulty over here. And you can see that basically below these lows here would be a high resistance liquidity run. It would take a lot of money for price to push and blast through these levels over here. That's where that whole mentality of a trend line essentially would come in, without understanding anything about liquidity or order blocks or price action. This is where that whole mentality of a trend line would come in, because they'd say, well, oh, okay, well, if it's going to sell down here, it's very likely that if we say put on the closing price here, it's going to do a trend line retest, and then when it gets to the trend line, that's what's making price go higher over here. Meanwhile, it's got nothing to do with that. It's just pure coincidence. But yeah, that's probably a long answer, Temitope, to what you asked about differences of mitigations or how to identify it. But like here, this is a higher time frame mitigation. So if we looked at this, for example, this would be a failure swing over here. This is let's just clean this chart here and go back over there to the line. So in terms of mitigation, this is a higher time frame mitigation, this little area here. Why is that a mitigation? Because this swing high failed to take out this swing low, and then it got traded through over here. So you can see they failed to take out that low over there. So this is mitigation. So price basically created mitigation when it closed above it, and then when it comes back there, we can anticipate that there would be some kind of mitigation to occur over here, because if it's in here, it's above inside of the buy side liquidity, so there'd be a retracement, and then this is what we can expect a retracement from, and that's a weekly mitigation. But obviously that's quite large, that range over there, so you'd have to come down to something of a daily. So you'd say that's a weekly mitigation, and then you'd sort of wait for any sort of external range liquidity, and then you could see here the price traded this external range liquidity over there. Over here, pretty easy to see. If we do this, after this impulsive move to the upside, there was this consolidation. Price expanded down with a low resistance liquidity run on the lower time frame, grabbing the liquidity over here, and then traded higher, eventually expanding in the direction of the anticipated order flow on the daily and the weekly and the monthly, which is bullish. Temitope, are you here? Your mic's muted if you're going to say something.
Yeah, no, that makes sense. Thank you.
Yeah, those mitigations occur pretty much anywhere, eh? Like it's one of the most common sort of things one could trade or find in the marketplace, like sitting at the charts every single day on any time frame. And obviously the higher time frame you go, the more relevant or the stronger the concept would be, as opposed to like a 1 minute versus a 1 hour versus a 1 day, obviously they have various levels of significance. But it would essentially go towards whatever your bias is on the higher time frame.
Yeah, that makes sense. And kind of another question that stemmed from this and reminded me is that when I'm doing markups, like you said, a lot of the time, like it's from where price currently is, the areas of interest that I'm looking at, it's like ages or not ages, or it's quite far away, should I say. So I'd have to, or anticipate that I'd have to wait a long time for it to touch either of those like areas of interest. So I just want to know like how to narrow down your entry essentially. I know you do like the top down analysis, but yeah, just any more detail on that would be good. Not sure if it's a question for now even.
Well, it's not really a question for now, but we can just lightly touch on that. So based on what we see here, well, what do we see? This is USD CAD on a monthly, so it made a swing high over here, and then it kept on trading lower, 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 and out of nowhere it randomly just reversed over here. But is it really random? Does that look random to you?
No. Probably if you like zoom out.
What do you see just by this particular area of the chart that I'm looking at without zooming out anymore? What do you see happened?
An equal low, or like a relative equal low with that July 2017?
Yeah, so basically only after price traded lower than this low over here, so underneath this low, for all of this, swing high, swing low, swing high, swing low, swing high, swing low, and price trading higher, each of these lows, and this one being the lowest low, would have the most liquidity in terms of
Yeah,
sell side liquidity. So they would say that once this low is broken, they're going to put sell stops there because it's going to continue going lower. So there'd be a lot of liquidity as price moves away and makes higher highs and higher lows. They're essentially saying that this is a point of liquidity. But if we look at what happened over here, essentially it came below that low. So this over here, you can see there's equal highs there. So it traded from this high down to this low and from this low up to this high. So it's maintained liquidity over here by not trading below that low, but taking this low over here. So we're sort of drawing a story of price action as to what's happened. So it took the liquidity over here, it failed to take the liquidity over here, and while trading inside this range, obviously all of this area of price action here, 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 to the downside has all been taken. So all of this liquidity here, like sort of like that, has been taken. So currently external range liquidity would be over here and over here. So that's quite kind of the range that we are trading in terms of where we are looking at the monthly chart. And obviously there's going to be various levels of this is internal on a monthly, but external on a daily, external on a weekly, external on a 4 hour, etc. like that, with the swing highs and swing lows. But essentially what we're saying is that price definitely wasn't random. The fact that it traded just below that low and then price decided to reverse. And then when it reversed, if we missed that, what does it make first? Well, it makes that old low, right? It makes an old low. So if we think how PDA would work, where's that PDA now? When we look at that PDA over here and how it works, essentially, all of this over here is how it started. This is the old low that it formed or raided, because below the old low would sit liquidity, and below that old low sits liquidity. And if that's the case, then we'd get a new old low form, we'd get a new rejection block, we'd get a new order block. And because now they're going to reverse price, it's likely that after the old low, after the rejection block, after the order block, what do? They create a low resistance liquidity run, which is indicative of order flow. So what is order flow? Order flow is showing expansion on a higher time frame, not talking like 1 minute, 5 minutes. It can be, obviously, if it's in the same bias as the higher time frame, but particularly higher time frame, 4 hours and above, daily plus. This is order flow. Order flow is creating a low resistance liquidity run to target either internal or external range liquidity. So when we trade ICT, there can only be two types of traders for ICT. Either we're people who like to trade internal range liquidity, or we're people who like to trade external range liquidity. I personally like to trade external range liquidity. Other people who trade order blocks prefer to trade internal range liquidity. However, they don't even understand the concept of internal range liquidity to external range liquidity. So they don't even know, like, what kind of trader are you, internal, external? They don't even know the answer to that question because they don't understand the context behind the marketplace. So when you provide context, we've come external, okay? So now we're going internal. So something internally here. Now, I'm not saying it's not going to take this high, but it's very likely that price may reflect and bounce and reverse somewhere inside of this internal range liquidity. And it's the same. If we go internal, we go external. So like if we zoom out here, if this failed to take this high here, it's still trading within this internal range liquidity. And if it went internal, it went external. And from external to internal, internal to external, external to internal.
Yeah.
Internal to external, and then so it goes on and on and on and on. One time frame's internal, there's another external. It's a lot to take in, guys, and it's not just going to come to you overnight. And there's always, a flow of questions regarding order blocks and mitigations, but really understanding liquidity is where it's at in terms of ICT trader. If you can understand the story of price action and what sort of reactions to buy stops we have. So I think I showed you this like 2 weeks ago. This is Euro GBP. I don't actually trade this pair, I just use it as a bias. There is some equal lows over here, and we get sort of this reaction off of this weekly over here. There's this trend line here, so it rallies up, takes all of this liquidity, it takes out that swing high, and then it reflects down. Where does it go from external to internal? Where's the internal? Well, over here, this is the internal. What can we find in the internal? Well, we have to look for the internal. So all of this over here is internal range liquidity. This is a low resistance liquidity run, and over here sits the equal lows. And then what happens? Well, price decides to, over here, take this lows, add some kind of discount, and show a willingness to buy. Where's it going? Well, it's going to go for the next logical level of where the buy side liquidity is. Because it goes from sell side to buy side to sell side to buy side to sell side. That's all it really does all the time. And eventually, if the order flow changes, it's not going to target buy stops, it's going to target sell stops. If it's not going to target sell stops, it's going to target buy stops based on intermediate long-term swing highs and swing lows. So that's where people think about market structure. You don't have to worry about what market structure is if you can understand where the internal and external range liquidity is and what it does with that liquidity. Because it's all very well marking up market structure, and then you're saying it's making a high or a low high or high, whatever, if you don't understand what it's doing with that liquidity. Because above a high would be liquidity, below a low would be liquidity. And when it takes that liquidity, what does it do? Does it reverse and take out the other next logical intermediate swing high, long-term swing high, short-term swing high? Okay, I'm babbling on now, guys, but could spend hours and hours on this, and it would either seep in or not seep in. But at the end of the day, it's very important to understand internal and external range liquidity, because that's essentially whether we scalp, day trade, intraday, position, whatever, swing, we're either taking one type of trade or the other. Either it's internal or either it's external, based on whatever ideas that you prefer to use from ICT. Okay, so enough with that. Any more questions, guys? Your mics are all muted, so if anyone's trying to speak, I can't hear you. Okay. Roger, you want to say something?
How's my sound? Can you hear me now?
Yeah, okay, go ahead.
Yeah, no, that's okay. It's really on the market structure, but for me, like I've been watching the breaker block, I think that helps me around market structure and seeing if it's a shift, either going bullish or either going bearish. So it's just on the market structure, but what you said now, it's not that you need to understand market structure if you kind of understand internal and external liquidity. So this is something I want to work on the chart because I was quite concerned about market structure. When does the market structure shift occurs? Am I going to go bearish? Am I going to go bullish? But when I use the breaker, like you explained it, helped. So not a question to say, more reflection for myself.
Okay, so don't get me wrong. I'm not saying, obviously, if you know what market structure is, I'm not saying it doesn't work. What I am saying is that market structure will be created or broken or whatever as a byproduct of raiding sell stops and buy stops and failing to raid buy stops and sell stops. That is the byproduct of liquidity. So wherever price goes to and from, the byproduct is it's going towards that because of the price is flowing in one direction and it's hunting buy stops or hunting sell stops, and because it's hunting buy stops or sell stops, the order flow is in a particular bias, and because of the order flow and the hunting of sell stops and buy stops is in a particular direction, you're getting those structures created, bearish structures, bullish structures, or however you think you know market structure. Okay, so basically that is, in a nutshell, what we can say about internal and external range liquidity over here. There's a couple of more notes over here regarding internal and external range. So the current trading range will have buy side liquidity above the high and sell side below the low. External range liquidity runs can be a high resistance or low resistance. We are looking for low resistance. Now that is the preferred trading condition. And if price is bullish and we have a move outside the external range liquidity on the sell side liquidity, we can expect a turtle soup. So if you were ever expecting price to reverse or turtle soup, this is it, external range liquidity. If price is bearish and we have a move outside external range liquidity, the same can be said, just in reverse. Okay, that's for external range. For internal range, when trading inside the internal range liquidity, gaps and voids are likely to be closed. Why? Because as a result of voids or gaps being created, we are moving away already from some kind of particular swing low or some kind of particular swing high. So for example, if we get a clean chart here, let's look here quickly, and we get that 4-hour chart, we make that swing high and we make that swing low. So we're trading currently in that range. So within this range is inefficiency. So for price to be efficient, what does it do? It trades away and then it closes the inefficiency over here. Sell side imbalance. And because of the sell side imbalance, there's no buy side. So CSIBI, sell side imbalance, buy side inefficient, which is a SIBI, which is maybe something you've seen marked up on the chart of an ICT trader, a SIBI, and this is a SIBI over here. So liquidity void, and then price closes that liquidity void either to the pip or not to the pip, or 90% of it or 98% of it, or whatever your broker would tell you, but essentially within the range you're looking for voids to close. So if you understand what voids or gaps are, then this is a void and this is internal range liquidity. And because this is internal range liquidity, where is the external range liquidity, which is over here? So it goes from internal to external. Voids are internal, and if voids are internal, then we go external. So basically that is internal to external, and that is essentially what we just said over here, is that price goes for a particular internal or external ranged liquidity idea. Good setups can form with a trade idea starting the internal range liquidity and exiting external range liquidity, which is what I've just showed you over here on Euro GBP. Okay, so this is where the higher time frame sort of overflows now into what we start to see about the PDAs, and it's something what Temitopi have asked if it's relevant. So it's sort of relevant, and if we get a bias from like a monthly or a weekly, and we say let's get whatever CAD JPY for example, and we start looking at the monthly, every time price makes some kind of, you know, swing low and expands away, retracement, expands higher, it's exceeding that particular range's liquidity. So over here, it's just taken this entire range's external range liquidity. So from this swing high all the way to this swing low, price traded lower, although it's internal range liquidity on other time frames, all of these swing lows here, 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 this would all be external range liquidity. However, internal range liquidity on the monthly, because that was not broken like that. However, we do see that it did take the liquidity, because that swing low of the closing price, as much as a wick of a candle has got liquidity, so too does the closing price. And you can see there that, you know, wherever there would be closing price plus the wick, price would like to trade into it. So sometimes you might not find that a swing low is broken, but it does trade below the swing low of a closing price, and that too is a form of liquidity rate. But don't worry about that too much now. You must just anticipate that that is how the market works. So what I was saying is, every time it creates a swing low and trades higher, it's creating a low resistance liquidity run, by doing the following. Trades low, it's in a discount, it's traded from a high all the way down to a low, fails to take out the low, and what does it do? When it takes this high over here, what is it doing? It's creating a low resistance liquidity run over here. And when it creates a low resistance liquidity run, there's a retracement. So before that even takes place, this order flow, we can see that price is trading higher, even the higher time frame, which is the monthly. It is expanding by creating voids over here, inefficiencies. And as an inefficiency being created on the chart, that is generally a byproduct of order flow, because why? It's now targeting the buy stops and no longer targeting the sell stops. And again, what happens? Every time there is lows and highs, what does it do? It expands through the highs, takes the liquidity, and then retraces. And then again, well, it just expands again. Low resistance liquidity run on the opposite end of the market, which is sort of over here, where that whole bias kind of changes. From here, I can just put a line there, and we can say that it did one last move outside of this consolidation, taking out all of this liquidity over here and some over here, and then price decided to trade higher. So this we could say is the breaker on the monthly, because that swing high, the last swing high that took out this liquidity over here, and then price traded through it. So this is actually a breaker over here. And if that is the breaker, then over here is the mitigation. And even over here is a mitigation, because this failed over here. This was a failure swing to take out this low, failure swing, traded through. And somewhere in here on a lower time frame, there would be some kind of mitigation occurring. And then again, this is the breaker, trades higher, comes in, retests the breaker. This is a failure swing to take out this low. So then this is a mitigation. Price trades through it, mitigates, trades higher. And at the same time, you'll learn this higher time frame sequencing of events. But all it's really doing is it's trading higher, making low resistance liquidity runs, voids and expansions in the order flow of the monthly, in the order flow of the weekly. So low resistance liquidity runs are the favorable trading conditions for us. And if we identify a low resistance liquidity run on a weekly or on a daily, and our price is, going lower or against that low resistance liquidity run, we can anticipate that that's just a retracement before a continuation of more low resistance liquidity runs, because that's how the market would essentially do. And where would it retrace back to? It would retrace back into your PDA. Order blocks, voids, underneath lows, above old highs, and that's what you'd essentially learn. Okay, I'm going to draft on forward here, but yeah, that's essentially our understanding of internal, external range liquidity. Okay, so we've learned what order blocks are, choosing the right one, and then we said that there was also a tip we could use the range of the order block depending on if it's like 30 pips, 40 pips, 100 pips, and deviate that 3 times to give us a profit target to exit the trade for a sell or a buy. Then we did mitigations, which was the failure swing, and then we did breakers, which is basically the turtle soup of liquidity, and then price breaks down that structure. And then you've probably seen maybe in that bonus video, I talk a little bit about a rejection block, but let me just dive a little bit more into that, and then we'll cover as much as we can with these guys. Most of them is pretty easy, so there shouldn't be a lot of time spent, but I'm just going to go anyway. So a rejection block is essentially, in terms of, apologize for that. Come back, seems like there was a delay. Okay, so here we're going to see what a rejection block is. A rejection block is essentially the last wick, if you will, before price decides to reverse at some point. Because why? If we look at what the PDA is, and we go back to the PDA over here, and we open this PDA again. What are we saying over here? We are saying that the rejection block over here is the last, or one of the very last, in terms of the discount over here. So when we are buying a rejection block, we are buying at one of the very lowest levels or one of the very highest levels of premium and discount. So generally before the old low or is created and there's a turtle soup, inside of that wick is where they start already to buy or to sell. And then because of the old low or the liquidity rate or whatever the turn of events would be, what happens next? After the old high, after the rejection block, then only comes the order block and then price sells or buys, depending. So before the order block is created, we get a rejection block over here. And where does a rejection block get created? So what we can essentially say is that let's just use this example as a bullish version. So let's say this is going to be a terrible rough sketch, but you're going to catch the drift. This is going to be a down candle. And let's say there's a wick over here, and then the preceding candle over here is bullish like this, and then we say, okay, great, that's an order block. Terrible drawing, I know, but anyway, that's the order block. So let's say that this over here is what our anticipation is that now price is going to retrace back into the retest of this order block. Let's say this time frame is a weekly order block, bullish order block, plus OB, right? So it's a weekly bullish order block, right? And if price retests this level over here, let's just say this level is whatever, 1.332, for example, at that retest of that order block. Okay, and that's a weekly time frame. Now, I'm not saying we're going to execute on a weekly. I'm saying that that is what we believe is that price is going to retrace now before it's going to go higher and into that order block, and then we want to buy at or near that order block. So that's what the bias is of the weekly. Then what we're going to do is we're going to go to time frame lower. It doesn't have to be the daily. It could be daily / 4 hour, for example. Okay, but anyway, it's going to be a lower time frame. Okay, and we are going to watch the price action that unfolds in this retracement, and when it gets to our 1.332 zone over here, that's what we're going to watch on the daily and the 4 hour, so that when price on the daily or the 4 hour trades into this weekly bullish order block, what would be the expectation, Roger, of this order block? What would we anticipate that if price was to trade into 1.332, are we going to sell or are we going to buy?
We buy.
Perfect. We're going to buy, correct. So that when price trades into this weekly order block, okay, what are the down candles on the daily or the 4 hour going to look like? Well, it's going to be sort of bearish candles, something like this. Terrible, guys, I know, it doesn't really matter. Okay, and we extend this out over here. Eventually it's sort of trading into the zone, right? And boom, price eventually decides to trade in here like this. Okay, one of the very first things that it's going to do to initiate that buy is this guy over here, this wick. So this wick is our first potential signal that we could buy. Think of it like if this was the order block over here on the left, right? A bullish order block, and that is a down candle preceded by a up candle, then this is a bullish order block, right? Over here on the weekly, because this is a down candle and they bought into this down candle over here and then made an order block by trading through it. So we know that we should buy somewhere around there. But because of the weekly being a weekly, we want to try and narrow it down. So we say that this is a weekly order block, and we come to the daily or come to the 4 hour, and we will try to buy inside of this wick over here. So what we're essentially saying is, just like the order block is the down close candle before the up close candle, this wick is the down close candle before the up close candle, because what is a wick? Well, the wick tells us that price sold but then bought and closed. That's what that wick is. It's sold and bought. That's what that wick is. So inside this wick, off of the daily bullish, or sorry, weekly bullish order block, there is now a rejection block forming here. This is now the rejection block, this guy here. This wick is the rejection block forming off of the weekly bullish order block. So it is a change, a potential change in the direction or creation of a new range. Why? Because if we look at what the rejection block is, it rejects price, having taken liquidity, traded into another array, and then creates a new array. And by the time we've identified the bullish order block, the rejection block's already occurred. Where does the rejection block occur? Off of another higher time frame. You could do this, I'm showing you weekly down to daily or 4 hour, but you could do 4 hour down to 1 hour, 5 minute, or whatever your procedure would be. But essentially that's what I'm showing you over here, is that this is your rejection block starting to form off of what we already thought was going to be bullish, so that the preceding candle, when it opens over here, because it's going to close there and then open, we can look to buy inside of this wick here. We can look to buy inside this wick because we anticipate that that rejection block wick is like an order block. They sold and then they bought, and it's already off of a weekly order block. So now we can anticipate buying to take place to form a new array for price to go higher and expand. Does anyone have any questions? That's something that you haven't seen here yet, and it's new, but this is a rejection block. Anyone got any questions before I continue?
Then another question, but maybe what I've observed sometimes when you have a move like this and it moves into the weekly order block, spends a bit of time and accumulates there before it moves. So I guess you've got to time it, because there wouldn't always be a sudden reaction from the weekly order block. It could sometimes spend a bit of time there, and then it consolidates a little bit, and then it makes the move after it's obviously picked up enough orders.
Definitely. So this doesn't have to be done from a weekly down to a daily or a 4 hour. I'm just showing you something that you can anticipate doing,
Yeah,
and give you enough time, for price to trade lower. And then when it gets there, you sort of set a price alert so that you know it's there, and then you're sort of just waiting for the next PDA to occur at this weekly zone of anticipated buying already. Emmanuel, go ahead. You've got a question. Your mic's muted.
Good morning. Good morning, Darren. Good morning, everyone. Regarding about the rejection block, let's say that okay, you can see the weekly order block is there, the void is there.
Yes.
Yes. The price came and works through the void in the order block, and the price moves away. Okay.
Yeah.
So then, in some case, the price come again on this rejection block.
Yes.
And weeks through the week, the previous week of the rejection block. We can consider that still valid rejection block, the previous.
Yes, because like this is daily or 4 hour candles, right? So let's say that the very next candle, we try to buy this order block over here inside of this wick, for example, but then below this over here would either be the previous day's low or, the previous 4 hour candle's low. So we already know it's bullish. So yes, for sure, we could move away from this wick, not breach the low, or breach the low, turtle soup it, and then trade higher. All I'm saying here, Emmanuel, is I'm not saying you must buy rejection blocks, but I'm particularly trying to create a identifiable scenario of when a rejection block will occur on the chart.
Yeah.
So whether it be from a weekly down to a daily, or a daily down to a 1 hour, or a 1 hour down to a 1 minute, it's regardless, because price action is fractal. Okay, so we anticipate the rejection block to form before the next swing high, swing low, pulling a fibs from that swing high and that low, because we are trying to predict or anticipate where is the next swing high and swing low. So when price sells, okay, and let's say, and then starts to move away here, it's already made an old low. It's maybe made already a rejection block. And because of that move away, these down candles over here would be an order block potentially. And then now you try and buy, that order block when it gets retested. Meanwhile, we are saying that we can potentially try to buy before the order block is created. That's essentially what we are saying about a rejection block, is that before the order block is created, the rejection block is created. Does that make sense?
Yes, it does.
Okay, so if we look at, for example, like a GU, and let's just do a 4 hour because that's one of the most popular time frames. Every time price would either buy or either sell or create a new swing high and make a new trading range, where is it selling or buying from? Every single time. It's not like there's anything that's different. It buys over here. It sells over here. It sells inside of these wicks and makes new swing highs and swing lows over here. Over here. They're pretty much all over the chart. Over here, it makes this swing low. Over there, for example. Where else? Anytime there's a swing high, something would have happened before it made that range. And if it's bearish, then you're only going to be looking for bearish ones. But obviously, if you're intraday trading, then it really wouldn't matter if you're buying or selling. So every time price is trading into these swings of price, or creating these swings of price, before that swing of price, before that old high is created, it's buying from some kind or selling from some kind of rejection block. Sometimes it doesn't make a rejection block, okay, be that as it may. All I am saying is that we can anticipate a rejection block to form off a previously traded level or another array, like I just showed you, where the weekly trades in and it's bullish, and then you go down to the daily or to the 4 hour, for example. So over here, let's look at this. This is where the next part of this comes in, which is this here. Hidden liquidity voids and how to identify them to use your advantage. So before I get to that, old highs and lows violated in a premium and discount, and then a large price reaction. That's essentially what an order block is. Okay, this will also form at an institutional reference point off of a higher time frame. Order blocks, voids, what you learned about institutional reference points. So if you've got an institutional reference point on a daily or a weekly marked up and you're anticipating for price to come in there to buy or to sell, look on your lower time frames, 4 hour, 1 hours, for those rejection blocks to occur at that PDA. We are wanting to see the wicks that have been created as bullish and bearish order blocks. That's exactly what I just said. Because before the order block, before the candlestick has been created of the order block, they are essentially selling before that order block over here. They're selling in the wicks already, or exiting their trades, if you will. Measuring the range lower and higher than the body of the candle. That's essentially where the order block would start generally, like open and closing price, but with the rejection block, it is beyond that. So in a bullish candle, it's going to be this swing over here, or this swing over here. That's essentially what we're saying. It's not the same as an order block where you mark up the opening price. It's essentially above that or below that. So here I've got a couple of examples. You can see here that's where they started to buy. So they buy in this wick, and then price moves away. So yeah, there's an order block, takes the low, whatever example. But essentially we are saying that this is the rejection block part. And then if price comes in there, it's a deeper level of discount. And then price moves away. So previous order block, so again trades down here, creates a wick, and then actually buys from this wick over here. That's sort of propulsion block thinking, second OB, if you will. And then here is a bearish example. So here makes this move higher, it rejects over here, and then they start to sell in this wick, and then price returns above this candle's body is high, and then boom, price sells off again. So here's sort of that example of that PDA element of things where we've marked up the swing low, marked up the swing high. This is a premium, this is a discount. Here's the OB marked up, here's the rejection block marked up, here's the old low marked up. I didn't mark up voids and breakers and mitigations, otherwise the chart would be just too busy. So here we got an old low, a rejection block, and an order block, premium and discount. And then here we got an old low, old high rather, and OB. So where does the selling start? It sells in the wick and it buys in the wick. And then when price comes in, what is it essentially doing? It's grabbing the liquidity of this swing low plus trading into the rejection block over here. That's essentially what we can say about rejection blocks. We should remember that a run on liquidity does not always have to occur on the wicks, but it can also occur on the closing price. Just like I said, price doesn't always have to raid the high of a wick, it can raid equal bodied highs. So that would come down to understanding price action, and sometimes it may not always trade above a particular high. For example, over here, it looks like there's one here. So it didn't take that high, but over here would be sort of equal highs sitting in these bodies, over here and over here. And you'd only see that either by knowing the price action of a candlestick chart, or just looking at a line chart, for example. So over here, traded this equal highs. It didn't take the actual wick, but it did take the equal highs of the closing price, and then boom, price sold, essentially. But you won't know that unless you sort of study price or get used to price, or if you do know that already, then that's good on you. Okay, so transposing to a lower time frame, looking at the price action inside of the wick will give us greater insight to fractal price action. Let me repeat. Transposing, meaning from one to another, that's transposing. When you look at the daily and then you look at the 4 hour, or you look at the 4 hour and you look at the 1 hour, that is what transposing is. So transposing to a lower time frame, looking at the price action inside the wick will give us greater insight to fractal price action. Who can answer that for me? Devakaran, are you here?
Hi.
What does this mean when you refer to rejection blocks?
Okay, so basically this gives us, the price action in the wick that gives us the overall understanding about how the liquidity is formed and how the market slowly moves inside the wick by creating proper structures.
Okay. Temitope, do you have anything to add to that?
And are you like asking us basically to summarize that number 6 essentially?
Yeah.
So to me, what that means is that from one lower time frame to another, the price action inside the wick will tell us what's happening on, like, because fractal means across all time frames. It'll basically tell us what's happening across all time frames inside the wick of that lower time frame, if that makes any sort of sense.
Okay, perfect. So both you, Temitope, and Devakaran are correct. When we say it, we transpose from one time frame to another, the wick that we identify on one time frame, looking at it from a lower time frame, will give us further data or information that that time frame doesn't necessarily show us on that higher time frame of the daily wick or the weekly wick or the monthly wick. We don't see all the individual candlesticks on the lower time frame in that wick. We just see that one big wick on the daily or the weekly, but we don't see the individual 1 hour candles or the 5 minute candles within inside of that wick. But what we can say is that this over here applies hidden liquidity voids and how to identify them to use them to your advantage. So you probably know what a liquidity void is or a fair value gap, okay? But what you may not have known is that just like there's inefficiencies in candle bodies, there's also inefficiencies in candle wicks, okay? So let me say again, just like you know what a void is, a bearish void, a bullish void, and you identify the body of the candle. So let's just say that we come to a daily chart and we identify the body of the candle as a void, for example. There's a void here. Let me look closer. There is a void there. Oh dear. This one here. So when we look at that, there is a void here. So just like there is a void in this candlestick, there is voids inside of wicks, which is what we could effectively give them a nickname of hidden liquidity voids. Okay, because while you may not see it on one time frame, it's just a wick, it's just noise. There may be something on the lower time frame that you didn't pay attention to or take note of. And generally we say it's a hidden liquidity void because inside that wick there's data. There's data to us that might be a reason to buy or to sell. So when we identify a wick, for example, let's look at the recent wick over here on GU that was created. So everything below this little box here is essentially what we are saying about that rejection block and the inefficiency of that wick. So this was, today is Monday, so this would have been Friday's candle over here, and then this would have been Thursday's candle. So before we see the price action right now, what did they effectively start doing? They started to buy inside of this wick over here. And when they did that, they did a little bit of a retracement down before continuing to buy today, which is Monday. So Friday was a little bit of a retracement down and then it went up. So below this black candle's body sits that rejection block or hidden liquidity void, if you will. Because when you go down to a lower time frame now, you don't see this bullish order block here on the 4 hour, which is not seen on the daily. That daily is just a wick. So like I just said, one time frame tells you it's a wick, another time frame tells you that it's an order block. Okay, that's a 4 hour. Maybe there's something else on another time frame that we didn't see. Oh, well, look at that. This wick that we saw on the daily over here is just a wick. But on this 1 hour chart, look how much data is there. This data tells us there's a wick on the daily. And then that daily candle closes over here. The next day comes, and what does it do? Well, on the 4 hour trades into the 4 hour order block, which is the daily wick. On the 1 hour trades into this inefficiency of price action. Why? Because, well, we know that that down move was bought up as an order block, but that rejection block is technically an order block because they sold and then they bought it up. So all of that selling was bought up, and that makes that rejection block on the daily, on the 4 hour an order block, and on the 1 hour a void. So that's where that hidden liquidity void comes in. That's why we call it hidden liquidity void, because that daily is just a wick. Remember, there's just a wick here. You don't know what's inside that wick until we go to that 1 hour, and there is that hidden liquidity void right there. And it's obviously across all time frames, before any swing high or any swing low, anytime there's a change in direction. So like over here, before price sold, over here it would have traded into this sell side imbalance over here and then sell. So this over here is a 4 hour rejection, and then price traded to this level over there. Now you don't know why it particularly traded to this level over here, but we know they sold in that wick. So if we go from the 4 hour down, there might be some information as to why this has a hidden liquidity void potentially. So 1 hour doesn't tell us over here. 30 minutes, does it tell us? Not really. 15 minutes? Aha, information. 4 hour shows a wick here. 15 minute tells us there's a swing high, and then it sells. 4-hour chart closes. What does it do? Closes this inefficiency of the 15 minute, but on the 4-hour it's just a wick. Let's remove this so we can pay attention solely to that one. Over there, we said that this is that 4-hour rejection. That's where they started to sell, so the very next candle would have closed, and this is a wick, and on that wick sits a hidden liquidity void over here, right there. So this is the wick, and that is the hidden liquidity void that you don't see on that 4-hour wick. That is a hidden liquidity void, which is effectively a rejection block. And, well, why did the rejection block form there on the 4-hour? You know, why did it want to sell there? Okay, well, that's going to come from knowing what a higher time frame would be. So like over here, before it sold, what did it trade into? This order block. So that's where we come and transpose down. This is a daily bearish order block, so we would anticipate bearish price action once price trades in here. Then we are coming to the 4-hour off of that daily, which is this zone over here, and we're getting that selling taking place. What is it telling us? It's telling us that this is likely to form an old high. There's the old high. Here's the rejection block. Here's the order block. Here's the void. Grabs the liquidity, make a new swing low, swing high, swing low, equilibrium, discount, premium, working inside of this array. So you're selling at the highest level of premium when you're selling an order block, or above the old high if you can do that. And when you're selling an order block, you're selling not the highest or lowest level of premium and discount, as maybe you might have thought, or maybe sometimes you get it wrong. But before the order block is even created, it creates the old high and the rejection block. And even over here, we knew there was a 4-hour order block over here, and they started to buy here. So if we mark this up and we say that this is a 4-hour order block right there, and we remove this like that, and remove this and this, make it clean, close those lines, we know that without any other lipstick on the chart that this is a 4-hour order block, because it moved away, it closed above the high over here with this, and then when it retraced, they started to buy. So on this candle over here, when this 4-hour candle closed on the 1-hour chart, this wick that is created over here, let's just do this quickly. This wick is where they start to buy inside this wick off of a previous 4-hour candle. Now I'm just doing this in a lower time frame, same thing. So what do we see? This wick is what's created off of the 4-hour order block, and inside this wick sits more information that we cannot see on this 4-hour chart. So what do? We have to go down to a lower time frame. It's likely that there'd be inefficiency in this lower time frame. Okay, it's not on the 1-hour. Okay, a little bit of an order block on a 30-minute, still not many inefficiencies we can identify. Still not many inefficiencies we can identify. And the lower we go, the more information in terms of price action we are going to get. They bought off the order block. So where did the buying really start? Well, it started down here, and then price moved away. So there'd be some kind of reason as to why price would want to come to a particular level.
Yeah, that was certainly part of it.
And where's that 4-hour zone? I forgot to put a line on it, sorry. Which is this here. So there's that 4-hour candle, and then we're going to go to that same level over here on the 1-minute chart, which is about there. And then now we see how price reacts off of that 4-hour rejection block. there's that 4-hour rejection block. So price would have closed there, creating that wick that we previously saw. So this little red box here is price closing, and then now this is that rejection block formed. So all of that is the wick, and price trading into that wick. So before that 4-hour order block was created, as we see here, the next one, before that's even created, where are they buying? In the wicks. Before the new PDA is started, in the wicks, that's where they are buying. Or if they're selling in the wicks. Happens all the time, guys. You just have to really just pay attention. And it's not just you know, GU that's doing it, for example. I mean, we could do pretty much anything. I know, what's his name, likes to trade the Vakaran, you like to trade gold, but I mean, it's really the same thing. Before they do any sort of retracement or reversal or any kind of anything, they're trading into a particular level and then they're buying in the wicks. So why did price want to come to this particular low over here? So only way we'd know that is there any kind of inefficiency in this 30-minute candle wick here? I don't know. Let's go look. To there on, let's say, a 5-minute. And I don't know if that's going to work because my data is not up to speed, but let's just try anyway. Okay, what is it doing again? It's buying inside of that swing low. So why there'd be liquidity there below that low. These PDAs just repeat themselves over and over again, but maybe on the 1 minute, if I can, there might be another void. Let's just see if I can do that. I don't think I can. When it made that low, so you could see there, hidden liquidity void in this 30-minute candle where it bought from in that void. Okay guys, this is going to end now, and then we're going to take a 5-minute break. Okay guys, so obviously a lot was explained currently. Does anyone have any questions currently? Anyone got any questions as you all join? Okay, so we're going to just do it one more time. So we're going to take a chart and we're going to say the weekly, and we're going to say, just like you've watched my YouTube videos, nothing's changing, everything's the same. This is an order block over here. Okay, why is it an order block? Because this obviously would have traded in here to this previous order block, and then it traded, went higher, and then boom, price went higher. So there's an order block there. Okay, so either this order block or this order block, you can see the reaction over there, you can see the reaction over here. So we know that there's an order block here, we know there's an order block here, and before price, we know that this whole area, we mark up the order block like that. Okay, and why am I marking it up like that? Well, you know, opening price all the way to the rejection block, we can do that, not a problem. So inside here is the order block, and what do we do with this? Well, we come down to the lower time frame and we say, well, inside this over here, we are looking for a rejecting candle for buying to take place. Where do we see that rejecting candle? Well, we see that price has made this long wicked candle over here, off of the weekly order block down to a daily. This here is now our daily rejection block below here, like that. So within this range, there must be a reason. Well, that daily is this 4-hour order block. And what happens? Price trades into the 4-hour order block, trades into the weekly. As Roger said, we mark up the weekly, we expect a reaction off of the weekly, but we don't know exactly where in the weekly there's going to be a reaction. And that's because it's a weekly and there's a lot of variation in price, and it's not as precise as the lower time frames, but that's how you use ICT price action, is you mark up and have a bias, and then when it gets there, you just wait for other bias on a lower time frame to signal you an entry. So again, if that is the order block and it's internal range liquidity, where is the external range liquidity? Over there. And when it targets that, so you buy the order block inside of the weekly, inside of the daily rejection block, inside of the 4-hour order block, this is your target. And while that may not seem like a lot, from here to here is 40 pips. But I mean, how much pips do you require per trade or per week? Are you trying to target 1,000 pips? That's ridiculous. You don't need that many. 150 pips, or not 150, 50 or 100 pips is a good starting point. Even, less, 40 pips, 25 pips. Start somewhere. You're not trying to catch 1,000 pips a week. It's not realistic. It's not essential to do that to make money. You just need to target what the market shows you. That's all you really need to do. Anyone got any questions before I continue? Nobody. Okay, Roger, thumbs up. Good stuff. Okay, guys, so that was our rejection blocks, and with rejection blocks comes the understanding that there's hidden liquidity voids, and we can take advantage of those hidden liquidity voids based off of a higher time frame when you couple them together. And then if you come to the notion over here, like I've shared in the group, there's a couple of factors that we, decide on when we talk or discuss about a rejection block. And the last one we said was transposing to a lower time frame price action inside the wick to give us greater insight to fractal price action. When we get these swing points, it's important that the candle color makes no difference to the order block inside the wick. We can have a rejection block on a bullish candle in a discount. Okay, so like with an order block, it really depends on the candle color, right? So there must be like a green candle or whatever candle colors you use. There must be a bullish candle with then a bearish engulfing candle to suggest that that's a bearish order block. Okay, but with the rejection block, it makes no difference whether the long wicked piece happens on a green candle or a black candle, in a high or in a low or in a premium or in a discount. It has got no regard for color of the candle, whether it be green or blue or orange candles you use. Candle color is irrelevant with a rejection block. Okay, and that is, there's a couple examples if you want to go and look at it over here, but that is rejection blocks. Okay, I'm going to move on here swiftly and try and see if I can wrap up all of these. They're not too difficult, they're pretty easy to understand, but let's move on over here. And I haven't taught this to you, but maybe you picked it up somewhere. And we're going to discuss what a propulsion candle would be. So essentially what a propulsion candle would be is, when identifying a bullish or bearish order block, we are looking for a second bearish or bullish order block created from the first order block. So essentially what we're saying is that if it's bullish, for example, price would have traded lower, and then somewhere down here, price would have then traded higher, making some kind of order block, and we mark it up over there in some kind of discount or based off of a higher time frame. And whether it be a 1 hour, whether it be a 4 hour, it's really dependent on whatever time frame you're using. But for the example, we're just going to say that this is a bullish order block. Okay, and what we are saying is that for a propulsion block, or alternatively known as a propulsion candle, okay, we're essentially saying is that when price trades into, this would be classified as OB1, which is order block 1. Okay, order block 2 should be created over here, higher than order block 1. It can't be at the same level, so we must have a higher order block created. It can't be at equal sort of creation point. It must have been created higher over here, like this. We can't get a case where price trades the same price action, does this, come up, and then sort of make an order block like this, where this is the order block and this is the order block, because then that is not propulsion candle or propulsion block. This is right, this is wrong. It must be that order block 2 over here is created higher than order block 1. And obviously if it's in reverse, well, exact same rule applies, is that we must have a lower order block created than order block 1 if it was bearish. Okay, I know some of you battle maybe with that, so let's just draw it up anyway, just quickly. So over here price goes up, and then over here it sells, so we mark up a bearish order block like that, and then price must come in here and create an order block over here like that, a lower order block. So it's not a propulsion candle yet. What makes it propulsion is the fact that this sensitivity zone of order block 2 is the propulsion candle, right? So we mark up the propulsion candle in a bullish format at the opening price, like we normally do with an order block, or at the opening price if we were selling over here. That is the propulsion candle or the propulsion block, so that when price trades in, if we're going to sell and touches that level, boom, it's going to sell. Or if it touches this level and buys, boom, it's going to buy, like that. That is what we are saying about a propulsion block or propulsion candle, is that the sensitivity lies in order block 2, but you need the second order block to create the propulsion block or the propulsion candle. Without that order block 2 having created it higher or having created it lower, there is no propulsion block or propulsion candle. So that is the rule behind the propulsion candle or propulsion block, is that we are looking for sensitivity at order block 2's opening price. And what's nice about a propulsion block, once we've identified one, they are generally quite sensitive. So either it's going to just touch the opening price of the order block 2, or to make it a valid order block, or valid propulsion block rather, we should not see price exceeding the mean threshold of order block 2. And obviously this would be order block 1 if we were selling, order block 1, order block 2. So price, we expect it to sell. However, we can anticipate that the mean threshold can still be held. So what's nice about this is that if you've identified a propulsion candle and you're trying to sell order block 2 or buy order block 2, we can really put our stop or our stop loss just above the 50%. So like 63% or 60% or whatever, maybe your broker spread is including that. But that's really where the sensitivity lies, because if it's not a valid propulsion block, then it's gonna go higher probably anyway, or lower probably anyway, and then you're gonna get stopped out anyway. So that's what's nice about a propulsion candle, is that if you've identified it to be a propulsion candle, you can use very tight stops and use the little bit lower or a little bit higher than the 50% mean threshold of order block 2. Let's just quickly look over here. So rules for a propulsion candle: second order block must be created lower or higher than the first order block. That's exactly what I've just said. We are looking for sensitivity at or near the open of the order block. The wick of the high or low also has a tendency to be sensitive. So when you mark up an order block, you must remember that when you mark up an order block, it's not only the opening or whatever price, it's also part of the wick that can be sensitive, especially off of a higher time frame as well, like a daily or a weekly, so even a 4-hour actually as well. But with order block 2, you could stick to either using the wicks or use the bodies if you want to as well. But all I'm saying is that we can expect sensitivity off of the wick as well. We allow price to come into the mean threshold, never more. So with the identified propulsion candle, we can expect that it can be 50% retraded to of the order block 2, but never more. So that allows us to have a tight stop. Obviously, if you're using a weekly propulsion, then in terms of how tight that stop is, could be quite huge, like 100 pips, versus if it was a 1-hour chart, just like 10 pips. So it's in regards to what time frame you use as well, obviously. we should not see prices lower than the 50% mean threshold as the stop loss. That's basically the rule. If it goes below there, then obviously it's not a valid propulsion candle, and therefore you're going to get stopped out anyway. But it's a good criteria to be met if you want to try and tighten your stops by identifying or using a propulsion candle. For additional confluence on the created propulsion candle, we want to see price close below or above the propulsion candle to make it validated. So over here, when we draw this out as another rule, you know, like I said, OB1 is created and OB2 is created, so we might want to just wait for the closing price of whatever time frame we are looking at, and then when a price closes, we want to see those closing prices close either above OB1 or close below OB1 if you're buying or selling. So that's what that means. Okay, and then yeah, once validated in regards to premium or discount, we want to take entry at the open of the candle, you know, if the order block, or 50% the mean threshold of the propulsion candle with a stop loss just below, which is like 53% or 60% of the propulsion candle, also including your broker spread. And then when framing up an entry on a propulsion candle, we need to use all previous knowledge. So it's not just, oh, it's a propulsion candle, okay, I'm going to sell now. You want to use other things to your advantage that you have either learned or going to learn in the future as part of a confirmation confluence system. So it's not just, okay, there's a propulsion candle, I'm going to buy it now. You know, you're going to confirmation and confluence that with other things you either have learned, already know, or still yet to learn in the future. But that is your propulsion block. Very simple, very easy to understand. If you know what order blocks are, then identifying a propulsion candle is very easy to know or to learn. Or if you understand what I just said, then great, good for you. Okay, so that's your propulsion candle. I'm not going to spend too much time on that. Also not going to spend a lot of time on a vacuum block because it's also not really that essential. But what we're essentially saying about a vacuum block is that think of it like a gap in the market and gap in price, and that when price comes into that gap, that missing candles that are not present on the chart are, you know, candle colors of the direction it gapped up. That's essentially what we're saying. So I'm just going to see if I can find a gap on one of these pairs here, maybe. Okay, so there seems to be a gap here quite quickly over there. Why is there a gap there? Well, if we look close, bullish candles close up. So then there was a gap from this closing price to this opening price. So there's a gap here to here. There's a gap there. And if you go to a lower time frame, you'll see that gap quite easily. This is quite quickly I'm doing this because it's really simple, but there's your gap over here. There's that gap we saw. So price closed and open, so there's a gap there. If we narrow that down, there's a gap there. So what we're essentially saying is that this is a vacuum block and that these up close candles have closed, and then when the next successive candle that created the gap, in this case the gap down, these are actually all bearish candles. So if we were to paint candles there in those missing candles, they'd be down candles, and because those are down candles, that would effectively make a bearish order block over there, and then that's essentially our vacuum block. So think of a vacuum block really just a big void of price action that actually didn't occur, and because of that it's like an inefficiency, so that price may want to come in and fill that inefficiency. And generally they happen like with big news events or like interest rate decisions, maybe a gap over the weekend. You've probably seen this if you've watched the charts enough, that they occur pretty regularly over a weekend. And also if you trade the stocks or the indices, they tend to gap up or gap down based on each session that opens and closes every single day. So there's a lot of gaps in that in terms of when you're looking at a stock market, but really the same application is treated, well, I'm showing you here on Euro USD, it can be treated the same as if you were trading NASDAQ or S&P 500 or gold or whatever other commodity you're trading. It's the same rule of thinking is that the missing candles that gapped in a particular direction are the same missing candles that should be painted. So in this case, it gapped down, meaning those are bearish candles. They gap down, so it's bearish candles. And that is your vacuum block. Let me just see if I can find one more, maybe on gold. Generally, they do happen quite easily on session by session. So there effectively is one. Sometimes they're easier to see on the daily. Gap. Ah, there we go. There seems to be a gap over here on the closing price of this green candle to that bearish candle. So there's a gap there, pretty easy to spot from there to there. So there's a gap there. If we zoom in there, you'll see it. So the closing price on this bullish candles close at the top, bearish candles close at the bottom. And you can see there, so this candle gapped up from here to here. And then you can see it on the lower time frame as well. Zoom out. There's that gap over here. If we narrow that down, there's that gap. So it gapped from here to here. So this is bullish over here. Now sometimes, like I just said, we can treat that as a bullish order block, but in this case you see that price basically traded lower, closed most of the gap over here, and then boom, price rallied higher, treating it as a bullish order block, but then only to fall back down. So generally that array has then been used in the same case over here. You can see it basically closes because the price opens here, closes there on the previous session, opens here, trades lower, fills in most of the gap, and then it rallies higher. Why? Because, you know, treat that as a bullish order block, so that when it retraces, you buy, close most of the gap. Sometimes close all the gap, sometimes it doesn't close all the gap. There's actually some rules here we can look at. But basically there is no trades that were executed in this range and therefore has become inefficient. Just like a liquidity void, fair value gap, you know, it's an inefficiency of missing volume of price, essentially. The absence of price tells us if the gap created up or down, and then we treat it as the candles open, high, low, and the close. Same what I just said. In addition to the gap, we are looking inside the gap for any up or down closed candles that would act like an order block. Divakaran, go ahead, you've got a question.
Can you please show me again how to identify these gaps? Can you please explain that again?
Okay, sure. But tell me first, what direction does a up close bullish candle close? Does the bullish candle close at the top or does it close at the bottom?
Bullish candle close at the top and bearish close at the bottom.
Okay, so simple then. Understanding that, you can easily identify it, whether it be a 4-hour, daily, weekly, whatever. So if we come here, I know you like to trade gold, so let's just make a new chart here, and then we put it on like a weekly chart. We can see gaps. They're easy to see. Like here, here's a gap, right? Agreed? You agree? This week over here would have gapped, right?
But okay, so okay, when you say there is a gap, but I could see wicks are already played in between there as well, right?
Okay, but don't you see that from when this bearish candle closed, all the way from the closing price here, there is a big gap. So basically, yeah, there's a gap here in terms of the closing price, but all the way from the opening price here, of the very next, from the closing to the opening, it gapped up here. Agreed?
Okay.
Okay, so we treat that as if it was an inefficiency. So if it gapped up, don't you, and you see there that it was bearish and then it gapped up. So what did it do? It traded down and gapped up. So those gap ups is bullish candles. So down candle preceded by bullish candles creates a bullish order block. So this is a bullish reaction, right? Okay. So that when this inefficiency over here from this closing price of this down candle to the opening price of this up close candle gets filled or gets traded into, that is seen as something that can be used as a bullish scenario from this closing price to this opening price. And when you come like to a 4 hour, there you see it. You don't see it on the weekly, but now more precisely when the market opens over here. Look at that. This is the date divider. So the market closed over here on Friday and then gapped up on the market open on Monday. So this gap up is what? It's bullish candles, right? Isn't it?
Yeah.
Okay. And because if it was a gap up, think of if we were to manually draw our own candles there, that gap up is a void, right? Because it gapped up. So what do we treat voids as? Or either a void closes and you take a buy, or it closes if you're taking a sell as an institutional reference point. Okay, so this is a vacuum block because it has got porous price action, meaning it's open. There's nothing that's been traded in there. So from the closing on Friday to the opening on Monday, this is an inefficiency over here. And we treat it as bullish because it gapped up. Happens all the time, like I said, either to session or like a big news, like interest rate or something, but mostly generally over a weekend. If you're trading like commodities and forex, but if you're trading indices and stocks, it can happen like session to session as well. And we are looking for those inefficiencies as a vacuum block. It can be a target for price to come into, as well as a signal for price to reverse. That's effectively what a vacuum block is. Okay, so early gaps created should fill by the London and into the New York. If we have this gap created in the afternoon, we have a higher chance to leave the gap remaining open when reacted off of the potential OB inside of the range. So generally what that means is that if the gap's now not closed by, let's say, the New York session of that particular day, it's unlikely to then fill it going forward. But if it's already closed or coming into it before the London, then take the trade, for example. So that's what we see here effectively, is that the London session would have traded to close the gap. But if we get it in the New York session, then that gap may not fill. That's what that rule says. Use it, don't use it. It's just a rule of a vacuum block. I don't personally trade vacuum blocks. However, I do use them as indication of inefficiencies of price. And because it's an inefficiency of price and it's an institutional reference point, you can take a trade based off of it or use it as a target because it is an institutional reference point. Okay, once the gap has been closed, we could expect or should expect an immediate response and displacement of price, or even a new order block to be created off of that zone. And that's why, because it gapped up and a new order block forms at that gap. So the gap closed, boom, new order block. That's essentially what that says, is that if there's a gap there and it's a bullish gap, so there's missing bullish price action or missing bullish candles, when price closes that gap, we can wait for the new price action candles to create a new, in this case, bullish order block. And here it is here. And then boom, bullish price action, retracement into the bullish order block, and then there we go. And it's simple as that. That's how it is, guys. So that is your vacuum block. When would the gap not close? It is possible that we have an order block inside of the gap on the same time frame or higher time frame, which means that if I draw this out over here to make it easier for us, if, for example, we're going to make a bearish gap, so or a bearish void, and then price over here, for example, closes at the bottom and it sort of like gaps down like this. Okay, so there's like this inefficiency from this price over here to this opening price over here. So this whole section from here, when it opens, is an inefficiency over here. Okay, we treat this if price has done something like this, for example, made some kind of bearish order block prior. Let's say something like this. So this is on its own a bearish order block, right? So that's a bearish order block, and then the market, whatever session or news or whatever, the next weekend closed and Monday came and it gapped open. This over here, we treat this as an order block, so that if price closes there, it may only wick in there, and we treat that as an order block. And then it can still leave this whole section as porous price action for later on. So there can still be that inefficiency. And sometimes it may wick in there multiple times. Generally it does that, and it continues to go lower, maybe trades in one more time, and then does the same thing again. It likes to, if you follow price action a lot, close that with closing price or a body rather than only wick, because sometimes the wick is not enough and it has to, if there's a gap in the body or the volume, it will want to close there with actual candle body rather than only just with wicks. Initially just wicks, but later on possibly with bodies as well. And that is your vacuum block. Hopefully that answers your question, Sivakran, but I don't want to spend too much time on that because it's not really as important as many other things, but essentially it's like we know what a liquidity void is. Okay. So guys, I'm not going to spend a lot of time on these two because we already sort of know what fair value gaps are and liquidity voids. I've discussed them. All we can take away here really is that a void of buy side liquidity is SIBI over here, so it's sell side imbalance and the buy side is inefficient. So although it's a liquidity void, we say it is a SIBI, and because it's a SIBI, we expect price to come to filter out all of this imbalance on the sell side, and there's inefficiency on the buy side. That's why we call it a sell side imbalance, buy side inefficient. And then obviously if it's bullish, it's a buy side imbalance and a sell side inefficient. So the easiest way I normally tell people to learn this, and if they forget it, because sometimes they get confused, they use a BISI for a selling and a SIBI for a buying. Think of the S in SIBI for selling and the B in BISI for buying. SIBI is selling, BISI is buying. BISI is bullish liquidity void, SIBI is bearish liquidity void. Think of it like that. So either you target a liquidity void as a target to buy into to close price, or you use that liquidity void that once it's closed, you sell because it's now rebalanced that inefficiency. So it's an institutional reference point. SIBI or BISI is an institutional reference point. And yeah, not much to talk about. Obviously, a fair value gap on one time frame could just be a small little area of inefficient price action, but on a lower time frame, lower than the one you're looking at, that could be a large liquidity void. So let's just quickly have a look here. So for example, let's just see if we can find like a daily fair value gap somewhere. Anyone see any fair value gaps? Okay.
Yes.
Where? Go for it.
This is on 1993 30.8, if I'm not mistaken.
Which month?
This is 13 April 2022, above the order block.
Over here?
Yes.
Okay,
You can
so
consider that.
okay, no, that's perfect. So fair value gap, right? But this fair value gap, while on the daily is a small little fair value gap, this could be substantially larger on like a 4 hour or a 1 hour, which is where I was going with this. So on one time frame, it's a small little fair value gap, and on another time frame, it's a large liquidity void. Oh wait, let's just do this and put this little marker here. Okay, so larger liquidity void on a lower time frame, but a small fair value gap on a daily over here. And then if you go even lower, you'd see a larger liquidity void on a lower time frame. So one time frame's fair value gap might be a liquidity void, or in reverse, one time frame's liquidity void might just be a fair value gap in reverse, either or. But that's just, you know, the difference. And what we said over here about low resistance liquidity runs is that you can come and read all this information, but you should know most of it about the fair value gap. We would like to go with what we see on the higher time frame as a general rule. So if we close the fair value gap on the higher time frame, but the lower time frame liquidity void is still open, we can anticipate price to trade away because the higher time frame overrules the lower time frame. So if, for example, you've ever seen this and you marked out like a 4 hour liquidity void, but you know, price closes the small little fair value gap on like the daily or whatever, there's this huge 4 hour liquidity void that's not filled, but the daily has closed its fair value gap and price blasts away, is because the higher time frame overrules the lower time frame. And you can go and check. I'm not going to spend more time. It's a very simple way of thinking. As best practice for this, it is best to use when trading inside of the range. This is now specifically fair value gaps, because like we said, fair value gap is part of internal range liquidity. So if we have a run on an external range liquidity, okay, or sometimes also internal, we can anticipate price to come back and close a gap that it has created as its next target. What do we mean by that? Well, how do we know what a fair value gap is? So simple thinking, same price action sort of area, we can see that it created a fair value gap here, and then price returned to the fair value gap after exceeding that external range liquidity of this low and this low over here, and then price returned to close the fair value gap, institutional reference point, and then once it's closed that gap, it continued its particular order flow on this time frame, which was lower over there. And then same sort of rule over here, it traded, made the swing high, made the swing low. So this is the swing high, this is the, sort of the area of the swing low, and within this range is the swing high and the swing low internal range liquidity, and this fair value gap over here is part of that internal range liquidity. And because it is internal range liquidity, we target external range liquidity over here. And obviously you wouldn't know that because if you tried to sell it, you would have had to wait maybe the whole week for it to close. But you know, this is where that higher time frame bias comes into the mix. Okay, and that is your fair value gap. And obviously, if we are creating a new trading range and we see a low resistance liquidity run, we are looking to where price was not efficiently offered to the buy side or the sell side once the range broke. So when we identify a low resistance liquidity run, like for example here, we are looking for once that range broke where price did not efficiently trade. That's effectively what we're saying about a low resistance liquidity run over here. Once it breaks a range, we are looking for where price did not efficiently trade. And even over here, once it breaks sort of this area over here, we can see there that it returns back to the swing highs internal range liquidity and goes external again over here. And this just repeats itself, whatever. If you want to trade a 5 minute, for example, as well, let's look at some recent price action. and we can see if it exceeded a particular range. So like, for example, this was recently a swing high and then it broke that swing high. So from breaking the swing high over here on gold, okay, it's likely that from this swing low here all the way from where it retraced into, there'd be some kind of inefficiency that it would have wanted to trade into. And also there was the swing low, which would be internal range liquidity. And if there was an inefficiency over here, maybe on like a 15-minute or a 1 hour, somewhere there, that would have been closed. There we go. Didn't even have to look at another time frame. We can see, look at that. So there's that. Once it exceeds that 5-minute range, creates a new trading range, low resistance liquidity run, comes back, retraces, and expands again over here. So here again, sort of the exact same thing has just occurred. Over here, it creates a low resistance liquidity run on this 30-minute chart, and then because it's created a low resistance liquidity run, somewhere in the low resistance liquidity run is inefficiency, and comes back to close this inefficiency over here. And you can back this up by like a higher time frame if you wanted to. Maybe over here where it retraced to would have been a 4-hour something. And you can see actually over here there was a mitigation block as we speak. Failure swing low to take out this low. This is your mitigation over here, and then price retrace into mitigation, take a buy, and then this is your target. And that's it, guys. I'm not going to spend any more time because you have a lot to work with, lots of information, and you need to start fixating on specifics that interest you. So good luck and good trading.